Listen to me. Market microstructure, it's not some theoretical debate. It's the cold, hard, mathematical execution of order flow imbalances. And whether you like it or not, the retail trader is the primary source of yield for institutional market makers. Okay, let's dive into this. But before we absolutely tear apart the market plumbing here, quick legal disclaimer. This is not financial advice. We're doing this for educational purposes only. And obviously, investing involves the risk of loss. All right, let's get right into the ground truth. The crowd is always wrong at the exact moment it matters most. And today, I will show you the algorithmic data proving that your bullish sentiment is Wall Street's exit liquidity. Seriously, all we ask in return is that you hit that like button and subscribe to the channel. Your support is exactly what allows us to bypass the noise and bring this level of in-depth institutional research straight to you. Oh, and drop a comment down below with your specific thoughts on the contrarian setups we're going to break down today. Now, you probably think buying when everyone else is getting greedy means you're just riding a trend, right? Well, the harsh truth is that mass retail consensus just creates a highly visible map of stop losses. And market makers, they are mathematically programmed to hunt that exact map. You're going to want to stick around until the very end of this explainer, because I am going to reveal exactly how you can front-run this algorithmic stop hunt. All right, Section 1, the ground truth, mechanics of retail flow. Think of retail order flow like a massive flock of sheep crowding onto this really fragile wooden bridge, right? They feel totally safe because they're all clustered together, moving as a single unit. But their combined weight is exactly what causes the bridge to absolutely snap. In today's market environment, that bridge is your obvious technical support level. And the sheep? Well, those are the retail stop losses stacked up in one massive, totally predictable zone. Just look at where these zones usually cluster. Retail traders, they almost always place these glaringly obvious stops right below whole numbers, or, tucked right underneath basic 50-day and 200-day moving averages. They're taught that this is sound risk management. Actually, scratch that. They're brainwashed into thinking it's sound risk management. But therefore, in reality, they're engineering a dense pool of trapped liquidity. It literally acts as a giant neon target for high-frequency algorithms. Just let this single number sink in. 25%. When retail demand surges 25% above previous peaks, it mathematically creates the absolute perfect condition for a liquidity flush. Smart money needs massive size to exit their positions, right? Which means your collective euphoria is literally what provides them the liquidity to get out. Moving on to Section 2, the informational asymmetry, dark pools versus lit execution. Now, this is where the total disconnect happens. Public markets, they absolutely worship these generic fear and greed indicators, treating them as momentum confirmation. But institutional dark pools, they view peak greed as a massive structural vulnerability. Because of this asymmetry, elite allocators simply don't follow the trend. Instead, they build short positions straight into the euphoria, engineering a massive liquidity flush to purposely trigger retail panic. 0. That is the absolute predictive value of those lagging sentiment indicators you're looking at. 0. While you're refreshing a fear and greed index, market makers are actively mapping live order book imbalances. You are looking at the past while they are ruthlessly mapping the present. Enter cluster analysis. Look, these algorithms, they don't need to guess where you're hiding. They use high-resolution depth of market heat maps to find exactly where your limit and stop orders are stacked. So what do? They sweep these highly visible levels just far enough to trigger the stops. That instantly converts your protective stops into a violent cascade of market sell orders, and then they just absorb your panic at a steep discount. This perfectly sets up Section 3, the macro impact, the 0 DTE liquidation cascade. Listen, you simply cannot trade today's macro environment without deeply understanding gamma. Gamma is the rate of change in an options delta. And here's the kicker. It's mathematically highest near 0 days to expiration. Therefore, a tiny, seemingly harmless 1% dip in the market suddenly morphs into a violent cascading liquidation, all because market makers are mechanically forced to aggressively sell just to hedge their exposure. Then, of course, we have Vanna. Vanna measures how that delta changes when implied volatility actually moves. So when volatility gets crushed, it forces dealers to immediately rebalance. This means all those late-day, hopeful retail puts get absolutely decimated by relentless mechanical dealer buying. And finally, we have Charm, literally the 0 DTE Grim Reaper. Charm is exactly how delta decays simply because the clock is ticking. As the afternoon wears on, the sheer passage of time forces dealers to aggressively dump their hedges. And that instantly kills those hopeful late-day retail rallies dead in their tracks. You really need to internalize this dealer hedging loop. It goes like this. Step 1, the price moves. Step 2, delta changes. Step 3, dealers are mechanically forced to hedge. And step 4, the move violently accelerates. The average retail trader is constantly getting shaken out of perfectly valid macro theses simply because their execution is way too crowded. Honestly, you are fighting the literal mathematical plumbing of the market, and you will lose.
So how do we actually exploit this highly engineered asymmetry? Section 4, the ultimate payoff, contrarian liquidity arbitrage.
Here is the core thesis, the contrarian fade. You absolutely do not ride the retail momentum. Instead, you fade it precisely at the moment the algorithm flushes the system. Let's break down the exact execution. Step 1, identify the higher time frame macro direction. Step 2, you map the retail liquidity zones, those incredibly obvious round numbers and standard moving averages. Step 3 is the hardest part. You wait. You wait for the algorithmic stop flush to ravage those zones. And finally, step 4, enter the trade in the direction of your macro-structural thesis, right at the exact second the retail crowd is capitulating. This spells it out perfectly. The retail trader sets up at support, gets inevitably stop-hunted, and is forcefully exited. The algorithm sees that imbalance, flushes the liquidity, and eagerly absorbs those orders. But you take the contrarian setup post-flush. You become profitable by siding with the smart money that's actively absorbing the panic. So the absolutely crucial takeaway here is this. Stop trying to predict the market. Seriously, start predicting the dealers. You cannot beat the plumbing, guys. Front-running the mathematical limits of the market makers is quite literally the only real, sustainable edge you have in today's tape. Which brings us to our final, undeniable truth. Your stop loss is Wall Street's target. They're not sitting there looking at the charts the same way you are. They are looking at your perceived risk as their ultimate high-yield opportunity. It's time to rethink your execution, start mapping the liquidity, and for the love of God, stop being the exit strategy.